Hello and welcome to the Daily Aus. I'm Sam Koslowski.
I'm Zara Seidler.
This week, technology stocks have been making headlines for all the wrong reasons. Major tech companies like Nvidia and Meta have seen their share prices drop significantly, with some analysts warning that we might be witnessing the beginning of a tech and AI bubble bursting. On today's podcast, we're going to break down what this actually means, how we got here, and whether this does look like the infamous .com crash from the year 2000.
All right, Sam, first things first. I do want to get on to bubbles. Bubbles feel like an important thing to get through. But I think a good starting point is to understand what's happening with tech stocks, because this is all related, right?
Yeah, so November has been the worst month for tech stocks in definitely a year.
Sorry to all listeners who have tech stocks.
Which is, as we'll discuss, pretty much every Australian, and I'll get to that in a bit. But the NASDAQ, which is a stock market index that tracks America's largest companies, and most of those largest companies now are tech companies, it fell about 3% over the past week. And that's billions and billions of dollars.
Yeah, it's funny because 3% sounds so minor.
Oh,
but
it's serious.
When you look at
it's serious.
It is.
But some of the world's biggest tech companies have actually seen sharper drops than that. So Nvidia, the company that makes the computer chips that power AI, it dropped around 10% during November. It's now bounced back. We'll also put a pin in that and come back to it later. Meta, which owns Facebook and Instagram, has fallen by almost 20% in the past month. And so this group of companies that Wall Street calls the Magnificent Seven, so it's Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. That's kind of the 7 powerful tech companies on the planet. As a group, they've dropped around an average of 5% this month.
Okay, I really want to understand why that drop has happened. But you started this by talking about a bubble.
Yeah.
So really quickly, what do you mean when you're talking about a bubble? And then secondary to that, take me through why this is actually happening.
So I think they should have called it a balloon, not a bubble. And I know that...
Who's they?
The terminology...
The peeps.
Police.
Yeah.
So I like to think about it like an actual balloon which is being inflated beyond its safe capacity.
Okay.
And a market bubble occurs when stock prices rise so much and so quickly and so far above what these companies are actually worth that something pops it. And once it pops, there's a very loud bang and everything comes crashing down.
Gotcha.
And the whole idea behind a bubble is that the prices that we're seeing on the stock market, they're not being driven by rationality or by kind of calculations that make sense. Instead, it's being driven by enthusiasm, by FOMO, and this kind of belief almost that these prices are just going to keep rising forever. And so the classic example that everyone uses is the .com bubble from the late 90s.
Yeah.
So that was when internet companies saw their stock prices go absolutely nuts, purely based on excitement that there was this World Wide Web and we were going to make a lot of money from the internet, even though most of these companies weren't actually making any profit. And when that bubble burst in about March 2000, the NASDAQ, which I talked about before, it fell 77%.
I guess, so you've said bubble, balloon, whatever you want to call it. The theory behind that is that something can get too big and it can just burst. Is that what's happening here?
Yeah, well, it hasn't happened yet. Okay. But the fear, especially this week, is that we are about to see that happen.
Okay.
And there's a couple of key reasons why people are starting to argue that.
Yep.
And the first is about money, just the sheer amount of money that's being put into these companies. So tech companies have been spending unbelievable amounts of money building the infrastructure that they think they need to make a lot of money from AI for the next 10, 20, 30 years. And we're talking about specialized computer chips, massive data centers. In 2025 alone, the world's largest tech companies are expected to spend about $300 to $400 billion US on infrastructure.
Wow.
And the problem is that when they're spending all of that money, we don't actually know for sure whether AI is going to generate enough long-term revenue and profits for these companies to make all of that back and more.
So they're investing now in the hopes that the returns are far greater whenever that's realized down the track.
Exactly. They're placing a huge bet.
Yep.
And one analyst that I was reading said tech companies have to spend to keep up with massive demand and to get out in front of the pack. But that demand hasn't yet translated into profits.
So interesting.
Yeah. And another concern is that the companies are finding it a long time to actually make that money back. So let's say that it costs...
They should work in media.
Well, that takes extra long. But, they were expecting it to take 1 to 2 years to make money back from an individual user, say with a ChatGPT subscription or a Claude subscription. They're now kind of saying it's going to take 2 to 4 years to see a return on that investment. And, that is a longer business model to have to support, which is why people are getting a little bit wobbly.
Okay, so you're saying there are some business models that are, I guess, resting on some hypotheticals that haven't necessarily been realized. And then there's this, on the other hand, huge volumes of cash being spent in the hopes that it does get realized, especially when it comes to AI. Have investors basically decided that these companies then aren't worth as much as they thought they were even a few months ago? Is that why we're seeing the decline?
Exactly. And this is not investors saying these companies are going to fail and aren't worth anything.
Yeah.
It's just saying they're not worth
as much as we thought.
The hype of what we're saying it's going to be right now.
I was fairly fresh to the world of valuing companies when we started our company. Yeah. And I was shocked by how much of the economy rests on hype.
Yeah.
And that when you're looking from the outside in, you can think that there, as you were saying, is this mathematical equation or rationality, but really so much of it comes down to hype. And all the hype has been around AI. There's nothing else that anyone has been talking about. AI and Ozempic, I'd say, are the two things that people have been speaking about.
Yeah.
And now are we saying perhaps the hype was unfounded?
Well, yeah, definitely cooler. There's a cooler temperature on this hype. But I do have to kind of defend the hype people, though. Somewhat.
Of which you are one.
I think it needs a bit of balance always, this discussion, because it's very hard to predict something that doesn't exist yet. But that's innovation.
Yeah.
And so it's very hard to be able to say with confidence, this is what we think we're worth, so therefore we're going to sell the shares at this rate.
Yeah.
And the other thing to remember is that if you look at the calculations of how much these companies are worth based on how much they're making, it was way more hyped before the 2000 .com bubble burst. So there's...
Do you remember it like it was yesterday?
Oh, it was great. I was
Back when I was
4.5 years
old.
So that, there's an example of Cisco. That was a company that took a huge hit in the .com bubble. There's a thing in finance called a PE ratio. It's basically how much a share is going to cost you based on how much a company is making. It's a score. They had a PE ratio before the bubble burst in 2000 of 148. Nvidia's current PE is 26. It is another scale, what we saw in the early 2000s, but it is getting dangerously high.
Okay, so there is, I guess, an example of this happening previously, but you've just said it was another scale. I want to turn now to something else that I've been reading about, and it's something about a circular investment in the AI industry.
Hello, Billy here from TDA. We have just looked at our YouTube analytics and 95% of you who are watching our videos aren't subscribing. If you want to help independent media like us grow, the best way you can do that is by pressing subscribe. Thank you so much, and back to the video.
Circular investment happens when tech companies invest in each other's companies. And one example would be that last month, Nvidia and Microsoft said that they would invest $15 billion in a company called Anthropic, which makes another popular AI product called Claude. At the same time, Anthropic committed to purchasing $30 billion worth of computing infrastructure, like chips and servers and stuff, from Microsoft that runs on Nvidia systems. So everybody is kind of buying things off each other and then investing in each other's companies. And that is, according to critics, similar to the .com bubble, where everyone's kind of interconnected. So you might have...
Why is that a problem?
Well, it's a problem because if one domino falls over, then they all kind of do.
Yeah.
And also it could be a problem in the fact that you might hear a headline saying that Company X has raised however many hundreds of billions, but maybe that's not real money. It's kind of just... if you help us out with some chips, we'll help you out with some computing power over there.
Yeah.
It's kind of in-kind transactions, and it's not actually about the real cash. But yeah, the domino kind of effect of a circular investment situation can be quite quick. If one goes down, the rest go down.
I was having a conversation with somebody about the fact that there are a few people who the world, it seems, trusts, that when they sound the alarm, everybody's like, yep, something is wrong here.
Yeah.
That's happened.
It has happened. And you'll know Michael Berry, he's the investor.
I didn't know his name, but we know.
He's the investor who was kind of made very notable for our generation in The Big Short. He was
Great movie.
He was the investor who basically said, I think the housing market is about to collapse, and he shorted the housing market. He recently disclosed, I think it was about a week and a half ago, that his fund had purchased $1 billion in bets against Nvidia. So taking a short against Nvidia. Essentially, he's betting that Nvidia's stock price is going to fall dramatically. Then there's Peter Thiel, who's another billionaire tech investor. He sold his entire Nvidia stake this week. That was worth about $100 million.
Crazy.
It's
crazy also that the patterns of an individual can influence so much. So we've got massive spending, high prices, circular investment, all things that I've just learned about, and big investors betting against tech stocks. What are the companies themselves saying?
Well, they're saying there's nothing to worry about. They're saying everything's
naturally
okay. And some of them do have a point. I mean, they're saying it's completely different from the dot-com bubble, the whole PE ratio thing that I said before. They're relying on that a lot. But some of them are profitable. And in the late 90s, almost no internet companies that went bust were profitable.
Interesting.
So yesterday, Nvidia revealed to the market that its profits in the past 3 months have gone up 65% from this time last year. In the last 3 months, they've made $32 billion in profit. They have banked $32 billion in profit, and that is just one quarter. Nvidia's stock price did jump on that news, unsurprisingly. It went up 3%, and that's why I said at the beginning it had a rough couple of weeks, but it seems to be on the recovery now. The other point that AI companies make is that we all genuinely are using AI more than we did a year ago. And there is genuine demand. They're not making this up. They are showing that every business almost on the planet and every school and every network is using AI. So they have a demand that they think they can meet. And so they're saying that data centers are running at about 80% capacity. And if they get higher than that, then it's dangerous that they'll kind of cap out. So that's why they need to build more data centers. It's not like
expensive.
Yeah, but it's not like no one's using this. And so they're just building more and more for the sake of it.
Okay, so started the podcast by hypothesizing about whether or not there is a bubble, a balloon, whatever we want to call it.
Yeah.
Is there?
Well, if I knew that answer, I would also have
man.
I would have The Big Short 2 done about me. And that is, I think, a really important point to remember, that no one knows.
Yeah.
And
everyone's
you
getting
hear
out
a
their
lot.
Crystal balls.
Yeah, you hear a lot about the ones who get a pick right, and they get made into a movie with Christian Bale playing them as a character.
Yeah.
But there are a lot who don't get it right. And Michael Berry, even, for example, has gotten stuff wrong as well. What I think is happening, though, is what analysts are calling a potentially healthy cool-off.
Yeah.
And so,
like, correcting itself.
Yeah, think about it like a big chill pill for the market. I like to think about it like it's a really fast car on a highway. And if you spin out at 150 kilometers an hour, you can totally lose control. But if you spin out at 60 kilometers an hour, you can kind of recorrect yourself. That's almost what investors are trying to do now, is let's just take the temperature down and calm things down. But people are losing a lot of money in that process.
Yeah. Well, I mean, I think that's a good point to end on, because we're talking about something that perhaps listeners are not quite understanding how it fits in with them. Can you just, I guess, finish on what it means for somebody, whether or not they are investors in the share market?
Well, I think if you have a super fund, you are invested in the share market. You just might not, at least at our age, might not realize that investment for another couple of decades. But most super funds, if not all of them, would have some sort of exposure or buy-in to the companies that we've talked about today. And when you talk about a company like Nvidia, its value is 8% of the S&P 500, which is the index that lists every one of the 500 companies in America. And most Australian super funds have S&P 500 kind of exposure. And that hopefully over time will be a really good thing as the economy grows. But it is important that we're all shareholders at some level, mainly through our super if we don't have shares directly. The only other thing I wanted to say before we kind of panic that things are about to burst is that, there was a big decline in the last month. But if you look at the last year, things are already a lot better than they were this time last year. So, you can picture the big graph in your head, and there's been
and then you drag it and it becomes bigger.
Exactly.
Yeah.
So over the long term, the kind of long-term investing philosophy still kind of stands true. But I think the really important bit here is around AI companies for really the first time having to justify properly the value that they have to shareholders.
So interesting. Sam, thank you for taking us through that. Really
Thanks, Zara.
appreciate it. And thank you for joining us for another episode of The Daily Aus. We will be back as usual with the headlines this evening. But until then, have a great day.